a trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade. Make your move.
Life goes by fast, really fast. One day we're 25 and living large, and the next day we're 65 and hopefully still living large. It's the 40 years in between that are mostly a blur. When asked what they would do differently, most people confidently say, nothing. I have no regrets. As much as I want to believe them, I know better. I believe there's one common regret virtually everyone chooses not to remember. It's the taboo topic of not taking as much risk as possible every chance you get. Remember, the genesis behind Tastylive was to encourage risk-taking. What were we thinking? Imagine the risk of building a business designed to encourage people to take risks. One of the things I've learned about taking risk, it's not personal. You can't let your ego dictate your decision making. Unless, of course, you're the richest person in the world, then it's a death trade. Another thing about taking risks is that it's never obvious. There are no easy decisions. Risk-taking should be fun, engaging, and challenging. But if it ever seems apparent, success will not be easy. The great thing about the world of finance is that success does not require genius. In my opinion, the model for success, without a lot of complex math, is relatively straightforward. It's risk times longevity. Between academia and financial media, we have overly complicated embracing the paradox of risk. It's finally time to simplify the model behind success to risk-taking times duration. This definition should give everyone hope and a reason to hang in there.
Are you on a quest for trading enlightenment? Driven by an unquenchable need to find the twin flame to your chosen strategy?
Our Where's Spat Live event is the search for trading's ultimate holy grail.
Do you have what it takes to find the elusive bat as we visit 3 cities?
Join 6 Tasty Live speakers
As they present 6 unique strategies
and 6 unique clues using games and probability
to lead to the ultimate prize. Sign up for this free event today at tastylive.com/events.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Oh, yeah, it is Wednesday, November 6th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, where we like to explore the incentives that govern our world. It's Wednesday, Wild Wednesday, everybody. You know what that means. That means we have the one, the only global head of macro here at Tasty Live, Mr. Ilya Spivak. Ilya, how you doing, my friend?
What a day. What a day, and 3 cheers for hedging, because that's what saved me today. Half of my portfolio looked one way, and the other half looked like the polar opposite. So I actually walked away today only slightly scathed. My pride in making the election forecast really suffering more than the dollars in the account. But what a day.
And I think a lot of people are in that camp, but we've got a lot to talk about. We're going to unpack sort of wild and crazy moves, I think, in yields and the dollar. We'll unpack individual assets. Also, I'm curious, man, is this just a vol crush? Is this an anticipation of future tax cut policy and a roaring economy? I'm not so sure. We talked about on this show to expect the potential melt up. But then once the dust clears, we'll see what's what. We're going to get into all of that. But before we do, let's say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tastytrade desktop and mobile applications. But if you want to be part of the conversations and have our wonderful producers put your screen names and your comments up on the screen, do me a favor, head on over to the evil, soon to be soon to be a little bit more neutral, Google. and Google's YouTube's. Type in Tasty Live. Find our channel, hop into, find this big head on a big red thumbnail somewhere and jump into the chat and introduce yourself. Type in random ass characters so we can spoof the Google algorithm into putting us in front of as many people as possible. Speaking
Johnson,
of the
turn
people,
that algorithm knob to neutral. We've had an election here.
Speaking of the people, since it's a podcast by, of, and for the people, and there are so few things that as of yesterday were by, of, and for the people, but as of today, a little bit different. We should say what's up to the people. Shout out to Brian Thornton, Joseph, Lone Sovos, Jay Wright, what's going on, VP. Ooh, it felt good to say by, of, and for the people today. Brian Watson, Cactus Leo, Sleepy Mocha, Donna, Linton, OE, I'm not going to do you justice. Absolute Beginner, so many more. We've got a brilliant mind with us. I wish I could shout all of you out, but we can't. We got work to do. Ilya Spivak, we got 90 minutes. It always seems to go quick, so let's get right to it. My friend, we can start with let's go straight to the market reaction because I want to focus on price today more than anything else. Market reaction. It's not, they took $4 out of the VIX. 20% collapse in volatility in addition to some of the air they let out of the tires yesterday. Let's start with vol, your thoughts on vol, and then how you felt that release of volatility, that release of tension permeated throughout all asset classes today.
Well, I think if you look at the outcome here, there is one thing you can say about it with absolute certainty, and that it is clear. You have a mandate. It's completely indisputable what this is. You have a win for Trump, not just in the electoral college this time, but also the popular vote. So there is a very clear, unmistakable result. And I think after what happened in 2020, the markets were concerned, especially if he were to lose, that there would be uncertainty, that the election would be contested, that it might drag out, that it could be maybe even mid-December when the electoral college votes are due, when we're still wrangling over this stuff and we don't know. That clearly isn't what this is. And so I think the markets looked at it and said, oh, good, certainty. We know for sure what is going to happen next here, at least as far as who's getting inaugurated next year. We're not going to drag this out. I think the vol crush makes sense in that context. I think that's at least part of why stocks are so high, why we had that unmistakably bullish response from equities. I think it gets a little more interesting and a little bit more policy specific for some of that equities run. But then again, very policy specific in the response from the dollar and the bonds and gold. And that's where maybe the situation in stocks is not as clear cut once the dust settles. But today, the response is obviously emphatic, and the removal of uncertainty, the clearness of the result, I think is a very big part of that.
Yeah, I would agree with that. I also think the one-sidedness had a lot to do with the bond move today as well. I had said yesterday in my conversation with Chris that I wasn't so certain that this bond move was based on one candidate's policies versus another, or changes necessarily in the probabilities, in the betting market probabilities. In my mind, what was going to fuel the day after move was going to be, is it close and contentious? In other words, is it a high likelihood of basically locked Congress, or is there it was a landslide in one direction or the other? Because if it's a landslide in one direction or the other, then you need to price that they're going to get movement on their actual policies, and you need to figure out a way to price that into yield. So I think we saw that today. Real quickly, just for anyone that wasn't watching, NASDAQ up 2 3/4%. The S&P, the underperformer, up 2.5%. Dow Jones up 3.5%. And the Russell was up 5 and 5.8%. What do you think fueled the Russell outperformance here, Ilya?
It's probably the one that makes the least sense to me, actually, because I think the giant upswell in yields is probably the most problematic for the Russell. So that the Russell had this massive tear, I think, is interesting. In my mind, the main sort of upshot when you look at the policy perspective, once you get past the clarity, is that we are going to get fiscal expansion. We are going to get tax cuts. We are going to get deregulation. All of that ostensibly makes, at least if you want to take the playbook from 2016 and say, okay, well, what did a Trump win mean? It meant tax cuts. It meant deregulation, and that's going to be helpful. And that's a pro-business set of policies. And in particular for deregulation, that's a helpful set of policies for smaller names that have a harder time dealing with regulatory burdens. So I sort of put that in this context. And of course, the banks did tremendously well. That's the part that I find a little bit strange. Because whereas I can see the big money center banks doing well, the regionals don't look particularly great if yields are surging. We start to talk about the Silicon Valley Bank scenario again, because, of course, all of those bonds that they're holding got absolutely shellacked today. And so we'll see if this continues. That's a part of the equities story that I look at today and go, okay, yeah, this is an election day response. Okay, I understand. But give it some time, and these regional banks aren't likely to be as chipper.
Yeah, I kind of had three themes in my mind as well. One, Russell was the underperformer. So on a release of volatility and tension, there's sort of where do you go to look for value in that moment? All of my small cap stocks just ripped. I mean, all of them just ripped. So it makes sense to me that the index tracking, 2,000, 1,500, 2,000 of those names moved higher. The other thing is they tend to get, I think 100% or near 100% of revenues from Russell companies come domestically versus, the S&P, something like that. You've got like a 60-40 split with international domestic revenue. So in America first, on just a first blush type move, that sort of made sense to me as well. But I, like you, I'm sitting back looking at yields going, is anybody going to notice? Like, when does the world notice the tightening financial conditions?
Yeah, the squeeze is back.
When does this honeymoon period
those
end
hands on your throat? That's the credit market.
When you gonna realize bonds are back to 116? I don't know, man. But I do think this.
And this is the opening volley.
That's right.
There's much more where this came from.
To me, I think the bonds are telling the administration what policies will fly and what policies will not fly. There's the crazy man in me sort of thinks that way. So outside of, let's go straight to bonds, man. Tell me what you thought of the reaction in both the short end of the curve and the longer end of the curve in terms of the 10 and 30 years.
Well, I mean, clearly we steepened in the curve. And that makes sense because we have a Fed meeting coming up in less than 24 hours. The market is not considering that they're not going to cut because they've basically talked their way into it at this point. The Fed funds futures have them at 99% chance likely that they're going to cut. It's difficult, but I can only imagine what would happen if after the move we saw today, the Fed did not cut rates tomorrow. It would be pandemonium. But they're almost certainly going to cut. The Fed is not in the business of generating pandemonium. So when you look at that against the steepening of the curve, all of this makes very good sense because you go, okay, well, the incidence of limiting rate cuts is a 2025 thing. And by the way, the reflation dynamic was out there screaming at people. We've gone to 60 basis points for next year. That cuts the market's outlook from mid-September in half.
Mm-hmm.
Only the Fed themselves saw 100 basis points for next year, and the market's like, yeah, 55 as of today.
So to your point, I'm just throwing it up here that while they're still going to move forward with a cut tomorrow. I guess tomorrow.
December's a little lighter.
Yeah, December has come down. We were in the upper 80s in the early part of this week. Yesterday we were in the 70s. Now we're at basically at 2/3. And so once you get into that 55% probability, anything north of 55 is they've historically gone with the market. Anything below it, that's anyone's guess. What do you think? If I had to put a line in the sand right now, and I said, what does your gut tell you on whether or not you think we're going to get a cut in December? Or if you don't want to play that game, that's fine. But just give me your thoughts around a December cut.
The way things are trending now, I think it might fall off the table because the U.S. economic data has been screaming hot. We just, nobody was paying attention, of course, this week, but the ISM Services Index came out this week, much stronger than expected, the hottest it's been since August 2022. It'll be very, very interesting to see how the political breakdown in the assessment of the economy flips now. It's going to become magically great in 6 months. No, the economy is great now.
I was thinking the opposite, that all of us, we had we went from all these great headline jobs reports and then revising them lower. And it seems like as we get to the end of this election, now it's like, all right, 12,000, which is continuing.
It's like,
still 12,000. You get a negative print going into the transition. So anyways, to your point, go ahead.
Well, yeah, so screaming hot service sector. And of course, that's 80% of the U.S. economy. So the U.S. economy is white hot at this point. The main takeaway from the report, in fact, was that employment grew at the fastest since September 2023 in the service sector. So not only
overall employment, not necessarily full-time employment, though.
Well, what we get from the ISM numbers is not levels. What we get is a pace of growth or contraction.
Okay, fair.
So the pace of employment growth in the service sector was the fastest since September 2023. And of course, when we look at the last jobs report, we have 2 hurricanes and a bunch of strikes in there. And we knew that. So let's see what happens in a report or two once those things shake out. What we definitely saw in that jobs report was that wages were steady, the unemployment rate was steady. So you got the sense that the payrolls numbers were kind of wacky and episodic, because the other stuff, the stuff that's not as volatile, unemployment rate held at 4.1, wages kept growing at 4, which is almost double the rate of inflation at this point. So that headline payrolls number was like, okay, yeah, fine. This is whatever. This is going to get revised away, and even if it doesn't, it's episodic to a month or two. Jobless claims have already fallen back down. This thing is going away. But the trajectory in U.S. economic data, that jobs report notwithstanding at the headline, increasingly better and better and better and better for 2 months now. And that tells me the Fed is going to come back in December if this trend continues and say, you know what, this is going to take us off our inflation bogey. We can't cut in this environment. And they're going to revise their SEP accordingly, dilute it for next year, basically line it up for this year where it's 50, 75 in total with what's coming up. Obviously, we don't want to assume, but almost certainly coming up tomorrow. And that'll be that. But I think December is now live as a skip.
I don't think they'll cut in December. I think we end up pricing that out one way or another. And I think possibly Thursday is the opportunity to start talking that down just a little bit. I think the market's already moving in the right direction. I don't think they need to be forceful about it. but I don't think they'll go in December. That would be my gut right now.
Probably not.
I'm almost scared to ask you this question because I know you can do something with it. So I'm going to ask you. I'm not going to put any boundaries on you. Okay, here's the question. So Cy in the chat says, Trump will demand rate cuts. You are our resident Fed watcher here,
yes.
And I think this is an interesting thing to bring up. I hadn't planned on talking about it, but it's a good point that Cy's making in the chat. In the way back machine, if we go back to Trump's last presidency, I don't think, if you were around then, the perception from the public is Trump kind of browbeat Powell into reversing course and ultimately cutting. Whether that's true or not, that's sort of the perception from the public. Yeah. What do you think happens under a new Trump administration post-inauguration? What do you think that relationship is, publicly and privately, Donald Trump to Jerome Powell? What do you think that is, man?
Well, I don't think it necessarily need be acrimonious. I think what we have last time is situational. And I think as we look at the way that Donald Trump engages with other policymakers, stakeholders, world leaders, you name it, it is case by case situational. He seems to be wanting to make a deal in every interaction that is relevant to the very near term right then and there. If it is not in Donald Trump's interest to pick a fight with the Fed, he's not going to. And I think the situation then was very clear. The situation then was the economy before COVID before COVID now. It's very, very important caveat. By the end of 2019 was growing at the slowest rate in 6 years.
Mm-hmm.
How did we get to the slowest rate in 6 years? We had a trade war and then a run of Fed rate hikes that was precipitated by the inflationary scare then, which followed a massive tax cut. So the fiscal policy last go-round said tax cut, inflation, rate hikes, but now those rate hikes are coming at a time when a trade war is weakening the economy. So in order for the economy to have digested first the sugar high of the tax cut and then the cooling on growth effects of the spat with China, it would have been better were there not rate hikes. But of course, the Fed has to operate with the evidence it has, and when inflation goes up and it starts to challenge its mandate, it's going to act. So the beef last time seems to be that Donald Trump looked at the Fed and said, you're raising rates at a time when my fiscal policy is sort of evening out against itself. And this isn't helpful because it's cooling the economy. That need not be the case here. Because what we see is a white-hot economy. We don't see a Fed that's racing to hike anything. If anything, they might back up off the cuts they already had in the works, but nobody's talking about rate hikes. And obviously, yields have already moved quite a bit. So we'll see if this relationship necessarily has to be acrimonious, but what I will say is if there is the attempt by fiscal authorities to directly meddle into monetary policy, not just talk in front of a microphone and try to jawbone and browbeat, which other presidents have done before. If there is an actual attempt to insert fiscal authorities by way of legislation into the monetary policy apparatus, formally, the consequences would be beyond catastrophic for the US dollar, and yields would surge to levels that would be incredibly onerous and start to speak of sovereign risk.
I agree. I agree with that for sure. What people say that at some level, The bond market is, and the Federal Reserve, I won't say that. The bond market's the only adult left in the room. It's kind of the thinking here. All right, so talk to me about the dollar, man, because I've been waiting all day to come in here and go, Ilya, what is this? tell me what this is in your mind. So take me through some of these cross currencies. We'll get to like individual stocks maybe a little bit later. We'll get to Bitcoin, gold, silver, all these incredible moves. We'll get to that stuff, but I think you start with the dollar before you get to all the dollar denominated assets. So walk me through what you think is happening here. What's the narrative behind some of these moves? What's the thinking and the balance of risk behind some of these moves?
Well, if anything, that this election just makes the disparity between the trajectory for yields in the US and the rest of the world more stark. We already had a situation before this election where the US is, as we've just said, growing swiftly. The Eurozone, one of the two other major engines of global growth, has been stuck in now back recessionary conditions for 2 months. We just got the PMI data confirmed for October today, as a matter of fact, and that's the second consecutive month of recessionary conditions for them. And China is stuck. They've warmed up a little bit, largely around sort of edge cases where the government basically gave people incentives to take their existing capital goods, like washing machines and things, and get rid of their old ones and buy new ones. So there's been a little bit of a forced function on consumer demand. But China is still basically at standstill. Moreover, we've had 6 consecutive quarters now of deflation economy-wide in China. So all of the other engines of global growth that aren't the US, the Euro area and China, they're stuck. And because they're stuck, and because, as we just said, US demand is primarily pointed domestically, you can see this even in the inflation numbers. Where is inflation? If we look at the CPI, the PCE, it's all in core services. Goods inflation year on year is actually deflationary. It's negative. Well, where is the demand? The price for things goes up when there's demand. If the price for things like goods is falling, there's no demand for goods. And most of what the U.S. imports is goods. Whereas what the U.S. spends on domestically is services. So the world economy, even as the U.S., the biggest economy, is booming, the world economy is slowing and has been slowing in aggregate since May. So you have a situation where yields are going in polar opposite directions. But the problem, of course, is that the whole world is powered by dollars. So even as U.S. monetary policy goes in a very hawkish direction relative to everybody else, everybody's cutting, but the Fed is now seen cutting by much less, and they're probably going to have to even dilute that. We've just talked about this. The dollar gets a yield differential shifting sharply in its favor. Notice where the top on the euro is here. It's the immediate aftermath of the mid-September Fed meeting where the markets go, right, you're going to pour 50 basis points in stimulus on top of a hot economy. You're not cutting. Not nearly with the vigor you think, because you're going to reflate everything. Yields up. That's also the top in bonds right there. So this whole thing is just a shifting of yield differentials in the dollar's favor. Look a little bit farther afield, though, and longer dated non-U.S. yields are also up with U.S. yields because the cost of borrowing for global commerce is measured in the cost of borrowing dollars. And the big risk now is, and this is also dollar positive, what happens when a world economy that can ill afford tighter rates has to have it because the U.S. is hot and fiscal policy is inflationary? That is a time bomb.
Mm-hmm. Time bomb for whom? For the rest of the world or for everybody, in your opinion?
For the rest of the world first. In fact, we see, for example, European stocks are down today. That was a short that worked for me. So you see that here. You see all of the currencies down against the dollar. It's a time bomb for them. The question becomes, at what point does an interconnected global world see this backfire? See weakness elsewhere reverberate back on the U.S.? And who's to say, but it's only a matter of time.
So let me ask you, I think you had, you're a risk manager. So going into this uncertain period, I think you had taken off some of the long dollar positions, but you still had some exposure.
Yes.
I am curious, given the move today, where is your dollar exposure now? How are you thinking about it now?
I took most of my dollar exposure, in fact, nearly all of it, off when we stalled on this move about a week and a half ago now. So you can see there the euro finds a bottom right around 108 or so, and then starts to kind of attempt to move higher. At that stage, I took off pretty much everything. What I had on going into the election was a little bit of long dollar exposure against the pound, which has been particularly soggy, and also because there's a Bank of England policy announcement this week that looks like it might veer in a dovish direction. So that was the only exposure I had. That was how I made money being long dollars today. I was also short the bonds. I was also short gold. I was also short.
By the way, I got to if I could shake your hand through the camera, I would, because that short bond move position you had after we've already had, in my personal opinion, after we had already made this big move, and then you coming in and going, I'm shorting him further. I'm like, whoa, this guy's got some stones on him. And, watching what ended up happening over the last couple of sessions, man, I want to shake your hand. Great call.
Thank you. I, as ever, am a follower of the price action first before anything else.
I wish I could, because you guys get to eat off those trends way more than people like me. Way more. I might catch a few turns getting lucky, but then I'm like, oh, that worked, I'm out. But you guys ride off of it for the next like 30%, 40%, 70% of the move.
That wiggle at the beginning of October in the bonds, where they wiggled higher, made me think maybe they were going to bounce. And so I got a little bit up and down on it. First, I got short once they broke. Then I exited and flipped long. And then when it failed, the only logical thing to say was, well, failed breakout, get short again. And it's difficult psychologically to be convinced that you should be short, then long, then short again within the span of a couple days. Yeah. But that's why you follow the price action. And so that worked. The thing that obviously didn't work for me today was being short U.S. equities.
You can't win them all. This is what I do. I go, the market's wrong. And then so I put on my position, and then I go, oh, it's still wrong. And then I'll add on to it. So I like diversify into it and just wait. Yeah. And then every once in a while, you go like, oh, I was wrong. So let me ask you then, you talked about your dollar position. I'm very open-minded
to the idea that at any given moment in time, I am completely wrong.
I'm not. I'm mostly right. And everyone else is just right. That's the way my twisted brain works. I'm just kidding.
I know I'll be right eventually, but at any given moment in time, it's like, well, I am not right today.
Yeah. All right. So then talk to me about, I don't think you necessarily have a price target here, but I guess this is me going back to that 210 discussion where a normalized difference between the 2-year yield and the 10-year yield is about 100 basis points. That, if we're in a healthy, strong economy, normally that's your that's your distance between the 2 and the 10, which we are nowhere close to right now.
Right.
So I guess it seems like I still like the steepener. I still think we're moving in a direction one way or another, whether it's we keep dropping the short end of the rate. I think the higher end keeps going up higher and higher the more they drop those short end rates, unless you're getting slower and slower growth into those drops. So then you kind of keep a lid on the long end of the curve. Anyways, my point is, is there a point in time, is there a yield that you go, I want to buy bonds when I want to buy the 10-year when it's 4.5 or 4.75 or when it's 5, or I want to buy the 30-year when it's 5%. I'm going to buy it. Do you think in those terms at all, Ilya, just in terms of like straight yield and where you actually think you have a value in a particular duration?
I don't think about it in those terms exactly. So there's not like a yield where I go, okay, if it gets to this level, like, okay, the 10-year is at 443 now. If we get to 480, okay, that's a big level. That's a big line in the sand. That's where I'm going to turn. I'm a little bit more price action sensitive. So today, obviously, the bonds set a lower low. Okay, we're going to keep going. But we're a little bit close to the next level of inflection here. If you look at the 10-year, the late June highs, somewhere around 4.5, 4.49, something like that. They're right here. Maybe we get some sort of a reaction at these levels, and I'm going to watch. I'm monitoring this very, very sort of day in, day out, because I think there's still a lot that can't be extrapolated. I mean, the markets looked at this today and said, right, so stocks should go higher, yields should be a lot higher, the dollar should be a lot higher. So we have a slowing global economy with tighter credit conditions, but stocks go up.
Mm-hmm.
Wait, what? Hold on. One of these is not like the other. Yeah. So I think there is some dust to settle. I think there are some things to get figured out here before you extrapolate very long. And of course, why would you be extrapolating now on the eve of a Fed policy announcement?
Yeah, makes sense. Makes perfect sense. All right, now we've covered the dollar a little bit. Let's head into dollar-denominated commodities. I'm going to save crude oil for a little bit later. I'm more interested in the gold, the metals here. So gold at 2670, down
Thank
from
God
27.
For this trade. My God.
What do you think this is about, man? You think this is strong? Obviously, there's the strong dollar element. There's the possibility of, you think, less geopolitical conflict in Ukraine, given Trump's promises. Do you think some of that, all of that, is part of this move? What do you think the narrative is here?
To me,
or you just think it was price move, just too expensive?
To me, it's more than anything the relief of uncertainty. We've talked a lot in the past couple of weeks here with Chris. All over. This idea that gold made no sense unless China was buying hand over fist again, because what was happening was the dollar was racing higher, yields were racing higher, and gold was going up. And you were saying, wait, hold on. What? This metal yields nothing. How is it going up when yields are going up? That's completely backwards. This metal is the usual foil for fiat currency. The dollar is going up. This should be kryptonite, this environment, for gold. So either there is a non-economic buyer out there again, a non-speculative, non-tactical buyer, like the PBOC was toward the end of last year and the beginning of this year, when they were just stockpiling gold, or there was just lots and lots of money sitting here waiting for the uncertainty of the election to get through. For any kind of sovereign risk that might have entered the bonds, that might have entered the dollar, were the outcome contested, were there to be some sort of shenanigans in the streets again. And we see today almost all of that move, at least over the sort of second leg of it over the past couple weeks, has been erased in a day.
Mm-hmm.
That
This
disconnect from gold and gold, the dollar, and yields, it got snapped back hard today.
Mm-hmm. $100 God candle. This chat had been looking for it. I think I'd ran something on gold at a good day. A good day in gold is about a 2% move to the upside. A bad day can be a 5% drawdown. And so when I did that math, I think we're somewhere around 150 points could be that 5% down move. We didn't get 150 points, but 198 point range in gold is a huge day. You were, correct me if I'm wrong, you're short here, yes?
Yes.
So you're short here. Again, I know the price action is going to tell you. And again, this is me trying to tease out how you think you're in a profitable position. Did you close it out when you get a 100-point move on the day? Or are you still letting some of the position ride?
I'm letting it ride here, because what we see is the close through the previous swing high. So the natural place where former resistance would have been support at about 126.85, 86, something like that. The next bottom here is going to be the October 10th swing low. That's about 26 at the figure. That's my next bogey. And by the way, the place where the dollar and gold start to diverge, late day in September going into October. October 10th, that low, that swing bottom that you see there, that's the spot where the divergence really starts to take off, where they both go up at the same time. If we consider how much of that move we erased here in one day, it's like 80% of the divergence is gone.
Mm-hmm.
So is it China buying? No. This looks like it was election uncertainty. And now it's been reset. And if what we're seeing in the bond market and the dollar bears anything like a connection to reality, and given what we know about the hotness of the U.S. economy and the economic policies that a Trump administration, especially with carte blanche from a united Congress, what that would look like, I mean, look at the bond market. That's what it's likely to be. Look at the dollar. That's what it's likely to be. Reflation. If that's the case and gold is back to acting like its normal self, there's more here.
More upside, you're saying?
More downside.
More downside.
More down, because yields are going higher and this thing cares again.
Yes. Got it. Is there a level where you're interested? I know you're not a guy who just goes like, I'm going to go buy gold or whatever, or I'm going to add gold to my portfolio. But is there a level where you start to, like, if gold gets down to 2,400 or in the range, is Ilya saying, oh, there's some value here, or is it's all situational based on yield and dollar and growth?
I think when you look at individual stock names, you can have a conversation of here's a business, here's its earnings outlook, here's the enterprise value. So a price over here makes sense versus a price over there makes sense. When you look at something like gold, the dollar, crude oil, you can't really have that fair value conversation. They're not that kind of an asset. What you're really doing is you're trading sentiment. And you're saying, does the market think this is expensive, cheap, or about right? And that becomes a conversation of talking about the price action. So I never want to be in a place that says, I want to be a buyer of dollar because it got to level X. Who cares? The market doesn't have to stop there. It doesn't have to get there. Nothing in the world says the market has to get to level X. Nothing in the world says it has to bounce at level X. It's going to do what it's going to do. So for me, it's always following the price action in the most simplistic kind of way and saying, do we have lower lows? Do we have higher highs? What's the bias? And where is the price action leading? And here we had a clear as day capitulation. We formed a very emphatic looking top ahead of the election. Thankfully, I was able to put on a put vertical here, and it's working. I'm not going to get in its way as long as it continues.
Let me ask you then, speaking of sentiment, only because I want you to kick the beehive a little bit. This will be fun. A massive move in digital assets today.
Yes.
In particular, Bitcoin. Just straight to the moon here from 68
Sure.
and change up to 75 and change, almost 76. Clearly, there's a representation here of moving on or moving away from the Gensler era, from a lack of clarity in the crypto business, and a more friendly Trump administration towards crypto. That's the assumption, right? Anything can change.
That's the assumption, yes.
It's a current assumption. So I'm curious to get your take. I know you don't necessarily get in here and swing around too much, and I don't think you're a long-term believer in Bitcoin itself.
No.
So why not kick the beehive a little bit? Tell me what you think's going on here.
I think it's completely sentiment-based because we have, of course, seen that the Trump campaign reached out to the crypto community. We've had some, I don't even know how to call this, but we have had a proposal. Is it a proposal? A sound bite from RFK Jr., who now is a part of the winning team, talking about
when he was an independent candidate.
When he was an independent
about,
candidate.
Yeah. Bitcoin reserve.
Putting the federal budget on the blockchain. I don't even know what those words mean. They sound like word salad to me. But because I'm not sure what action that actually entails.
It becomes. I'll give you the practical example.
Yeah.
The Department of Defense gets $800 billion. They have an $800 billion budget. They failed 5 audits. They've never passed an audit. So putting the federal budget on a blockchain makes it easier to track where money is going. Makes it theoretically harder to fall through the cracks. I think that's what they're speaking to in a very theoretical sense.
Very theoretical way. Right?
I don't know. I don't know how you practically implement that. But I'm giving you the theoretical framework from which they're pitching. But I get what you're saying too.
I agree.
How does that work?
I agree. There is the theoretical idea that you would create transparency by having some sort of a crypto or some kind of a blockchain-based tracking mechanism for spending. What that looks like, how you structure that, and how many decades it would take to start thinking about building something out like this, no one knows. But
if the government builds it, sure. But if the crypto bros build it, it'll be done by Sunday.
In any case, it would have to be implemented by the government, so it doesn't matter. The upshot here is that this administration that's incoming clearly has signaled, we're willing to listen, we're willing to engage, let's figure out a productive way that this goes forward. We're not going to clamp down, it's going to be more permissive, et cetera, et cetera. Maybe that's true. Legislative realities and election promises are very often not the same thing. But I don't know what that would even mean here in practical terms. Because what we have with Bitcoin at this point is an on-exchange ETF that has been the magnet for all of the liquidity that has, on the one hand, finally is starting to take these volatility levels down a bit. It's finally getting so liquid that it's not incredibly jumpy, but it also has meant that it has been cemented for all eternity as a speculative asset and not a pretender to money status. So just structurally, what is it that's going to change here? I'm not sure. So I think this is a sentiment reaction. That sentiment reaction makes sense, perhaps, given that sort of one administration is very clearly wanting for crypto, to the Gary Gensler point, to be more closely regulated, and the incoming administration being much more hands-off in their thinking, much more friendly to the space. So the sentiment reaction makes sense. Again, once the dust settles, I'm going to be curious to see what that actually looks like and means, because it's not clear to me what that is.
I'm not 100% certain it's more regulation, less regulation with regard to Bitcoin. I think it's regulatory clarity. And this is,
Maybe.
I'm not in the weeds on this so much, so I'm just telling you, this is like a secondhand perception that my perception is from people in that business is that it's hard to operate because there's so little clarity around what is a security, what isn't a security, what's okay by SEC standards and what's not okay. And that makes it difficult to make big bets in this space because you don't know when you're going to get the rug pulled out from under you. So I think, to me, I don't know if it's more or less, and it's just more just give us clarity so we can move forward.
Certainly there's a greater openness, it sounds like, to have a range of conversations in the incoming administration. So we'll see. But to your point, in practical terms, what does it mean? I have no idea.
Tell me, what do you think this election means to other global markets? What do you think it means for like Japan, China? You've talked a little bit about Europe, some of the emerging markets, Brazil. What do you think this means?
I think when we consider what this means for Japan, you have to put into context that Japan, like the US, like many other economies, is in the process of kicking out any incumbent government that was there during the post-COVID inflation spike. We've just seen it in the US. We saw it, a week and a half ago in Japan with that lower house election where the LDP lost its majority. We had decades of conservative rule in the UK, and now a Labour sweep. The Conservatives couldn't lose on the grounds of Brexit being implemented slowly and unevenly. They kept going through prime ministers. Is it Boris Johnson? Is it Theresa May? Is it Liz Truss, who famously lasted for less time than a head of lettuce? They couldn't get convinced to actually elect Labour. Well, post the inflation spike, Labour has swept everywhere. We're seeing Macron in France hobbled. We're seeing Germany's government on the verge of falling apart. Obviously, Italy has already had the change, and a more populist-minded coalition has come to power there. Incidentally, with quite a popular public stance still. So we have Austria, same thing. It just keeps happening over and over and over again. So when you look at sort of the implications for a country like Japan, which is looking at upper house elections next year, which has to have now a think about who's going to be their prime minister, even though they just appointed a new one before the lower house vote. There's a bunch on the table here, besides what's going on in the US and everything else. I think where you ultimately get a positive outcome for Japan is the squeeze on China is going to need allies, and Japan is the natural one in that conversation. So the more adversarial the current or the incoming administration, the newly elected administration, is going to be to China, the more it seems like it's going to want to engage with Japan. The flip side of that, though, is Japan is very much dependent on supply chains that run into the U.S. from not the U.S. For example, auto manufacturing in Mexico and Canada. So obviously that there's already a trade agreement there. They're relatively insulated in that sense, but the USMCA is up for renegotiation. And we know what the renegotiation of NAFTA looked like that gave us the USMCA. It was acrimonious. We know that the incoming administration likes to bully allies and trading partners into what it thinks are better deals. And with USMCA, you can even make that argument that it is a better deal than NAFTA was, if America first kind of ideas are what you're looking at. It's a more advantageous deal. So Japan is in the line of fire here. It's going to have to balance what happens on the trade side, the tariff side, and then what happens with them being a sort of natural beneficiary. They have a large U.S. Army base, and they're a natural ally in the competition with China. We're going to have to see. Ultimately, I think Japan is going to have to go and clean their own house and figure out their own politics for a while. But 6-9 months forward, this is going to be a really interesting thing to look at.
Let me dance
in
around.
In China, things look dire.
All right, let's actually go there. Let's go. Guys, I can't get enough of your Chinese economy bear porn.
Oh my God, they're so screwed.
They might be screwed, but FXI and a lot of this stuff, we said we would retrace, but in my personal opinion, once we got to around these levels, I was like, this trade's probably done. It's just not going anywhere. Grab a Snickers. That's effectively what we've seen. So I guess there's two stories here. It's what's the story of the economy, and then what's the story on the risk assets themselves. So let's break these two apart. Take me through the story of the Chinese economy as you see it currently.
Chinese economy is in horrific shape. The Chinese economy cannot buy demand to save its life. Its main issue continues to be that what it needs to do is manufacture demand of some kind, and it doesn't know how to do that. What we have seen them attempt to do is start to first ease monetary conditions. That didn't inspire anybody. They just socked away the extra money. You had them attempt to do it by trying to bully the stock market higher. It worked for a while, then didn't. Because after a while, you need for the market to take on some sort of momentum of its own. And with no demand, no, people are not spending money to buy these things. Foreign direct investment is collapsing at a double-digit year-on-year clip for multiple quarters now. The economy is in 6 quarters of consecutive deflation, which means there is no demand. The price for things doesn't go down when there's demand. It goes up. When the price for the GDP of a country in whole is actually going down, what that's telling you is that the whole economy is on discount because there is no demand. So you have a anemic situation, very much wanting fiscal policy support. But then the question is, what does that fiscal policy support look like? More debt-driven build-out of ghost cities, which is crashing the housing market, which is the genesis and the epicenter of this death spiral? What are you supposed to do? And how do you do all of that in an environment where your middle of the global supply chain economy, whose main where to sell is abundant labor for value add processing? How do you do that when the world is shifting supply chains away from you and your population is rapidly aging into obsolescence and you're losing your cheap labor offering, which was the core of your business model from the start? Where's your exit here? and it's unclear. Maybe you go and spend a bunch of money to actually get people to consume. Maybe that's what you do. But so far, all of their efforts have turned up a dud. Now, maybe they've been, and The Economist, I should give full credit where it's due, The Economist made this argument in this week's issue, that maybe China has been holding back the fiscal bazooka for a Donald Trump win, to basically say, let's see if he wins, and if he wins, then we'll really need to spend the money because he's going to squeeze us. Let's not spend the money until he does. Let's see. But so far, everything they've done has fallen flat, to say the least. You can't, I think, on that basis go short the domestic markets because they can will those higher. Xi Jinping can basically mandate the sovereign wealth fund to say, here ye go buy the stock market and it's up. I think you have to bet elsewhere. And for me, that's been the Aussie dollar. I'm very much looking to put that back on.
I still own some of this stuff. So I'll all the same stuff. They're collared up. So at some point I'm going to have to make a choice because the collars are expensive, right? So there's drag on these positions, which is okay if you're getting some return on the equity because that helps to offset the payment for the protection. But if this thing's just going to sit still, I don't necessarily have the confidence to leave these things on with no real protection. So at some point I'm going to have to make a choice, either hold these things without as much downside protection or let them go. We'll see what happens. I'm curious then. I want to go to the U.S. for a little bit. I want to talk about some individual names that moved today that are in line with the political narrative. One of the biggest or most notable is going to be Tesla, up to 289 high, closed at or near the highs. Clearly, there's some risk that was priced in if the election had gone the other way, that there would be some personal risk to Elon Musk. What that was, who knows? But all of that came out today, it seems.
Yes.
What do you think about Tesla here? Is that really what this was? Just the risk of the personal liability or potential liability to Elon Musk coming out of the market today, or think there's something else here?
Well, I mean, I don't think it's necessarily personal liability. I don't think anybody was going to go after Elon Musk personally because of what he said. I don't believe in that kind of thing. But I think what certainly was happening was obviously a very public endorsement of a political candidate by a huge defense contractor, if nothing else, and obviously things were muddy, and there's sentiment considerations here. The same way as with Bitcoin. If Trump comes out and loudly embraces Bitcoin and then wins, the gut reaction is Bitcoin goes higher. If Trump comes out and loudly embraces Elon Musk and Elon Musk loudly embraces him, and then Trump wins and Musk was right, and he bet on the winning horse, I think the understanding, especially from somebody like a Trump that likes to do a deal-making style of governance, that you're going to, first of all, have a situation where Musk has his ear. So in the competition between Tesla and Chinese EVs, maybe there are some sweeteners in this deal for Tesla. Who knows? But the gut reaction, the sentiment reaction is, here was a company and its founder who picked the right horse. They're going to get something good out of this. Buy. I think when you look at it somewhat zoomed back, like if you look at a weekly chart rather than a daily one, what you find is that Tesla is basically at the top of the range, about $300 or so. It's just a little bit shy, that it's been sitting in since July of 2022. So what has actually changed? Not sure. it seems to be at the top end of what has been normal for it for 2.5 almost years. So now I guess is decision time. Now we get to go and see. If we are, let's say, if we close above 315.20, then you have a breakout on your hands. And maybe that's a buy. But at this point, you're much closer to the top of the range than any semblance of support. So the risk reward to going long here, in my mind, doesn't make a whole lot of sense.
I'm kind of this. I'm the same here. I actually I'm long stock and was long some crazy 240, 250 call spread a handful of times, and I was pissed off because there's so much vol still priced into Tesla. That thing, we're at 290, and that thing is still only open up to halfway, and so basically it has even though it's a long call spread, it had positive theta, and I would have to sit on that for 2 weeks to let it open up, and I was like, screw it. That's why I sold it off today. I don't have the patience like you. I wish I had patience like you, but I just don't. The other one, really quickly, I'll note before I get to banks here, just a second. I know we talked about regionals, but I want to talk about some of the big banks here. Was Geo. This is a private prison, and we had talked about the potential. I thought on a Trump win, this thing's going to do insane stuff. It did. It was up 39% today, and I thought on a Kamala win that gun stocks would do well. SWBI, RGR. I guess we'll never know, but those they traded lower here today. So it seems like at some level that was priced into market expectations. But the banks, to your point, like Wells Fargo today was insane. Goldman Sachs today, insane. All of these, some of these large banks.
Take a look at KRE. Because that's the one.
I had that up earlier. KRE, we had that one up earlier. Insane.
Yeah.
Discover Financial.
Yeah, you look at KRE and you go, okay, maybe I get Wells, I get JPM, I get Citi, I get the money center banks. What's going on here?
I don't know what the answer to that is. I mean, I think it's yield related. Obviously, Obviously, maybe some deregulation coupled in there. Who knows? Let me ask you this, okay? So now that we've had sort of this vol crush, we're back into what would be a long-term historical volatility average. Could they take it in a little bit more? Sure. But it seems like, given the velocity and the nastiness of this move, that that was a one-day reversion. What happens tomorrow? In other words, how do you start to think about risk assets now that we've had this vol crush? Does Ilya say, okay, now that the event is over, we've gone through the vol crush, does Ilya come in here and say, I'm going to get short? Or have things materially changed for you into a potential Santa Claus rally, which we're going to start to hear people chirping about and writing articles about soon enough? In a couple of weeks, you're going to see it. Or is Ilya sort of preparing for a shift in risk sentiment? Tell me, now that the vol crush is over, how are you thinking about risk, man?
I think the biggest kind of thread for me now is we have a clear path forward that says, and I don't think we didn't have this before, but I think the market clearly, if you look at gold, if you look at the vol crush, if you look all over the place, the market wanted to have speculation become reality to really sort of anchor on this. But we're going to have fiscal policy that's inflationary. We have a central bank that is not hiking at its most kind of baseline and is, in fact, cutting and wanting to cut. That's inflationary. You have the incoming administration that is going to be inflationary by its own proposals across a whole range of vectors, be it the tariffs or the deglobalization or the tax cuts. You name it, it's inflationary. And stocks are looking at a bond market that's tightening its grip around its neck. And that basically says all of this inflation is going to have to get compensated somehow. and it's going in the yields. And there's no way around it. No matter what the Fed does, if the market thinks the yield is too low, it'll go there. We saw that after the Fed's September move. The Fed goes, here's a 50 basis point cut. Here's all this easing that we're going to project out for the rest of this year and next. And the market went, right. Very, very good. Yields up. Why? Because this is the wrong compensation in the bond market for how much inflation you're stuffing back in here with all of this. I think that's going to continue. And the really big question next year is, what happens when refinancing cliffs and a slowing global economy, which inherently makes managing debt more difficult because debt to GDP levels rise if GDP is falling? What does that mean at much higher rates next year? If you were looking for a sort of dramatic credit event, it makes sense that it hasn't happened so far. As it turns out, and again, hat tip to The Economist and the IMF that put this data together, in every other tightening cycle since the 70s, credit outlays by companies have increased. Of course they have. That's the whole idea of a tightening cycle. They didn't increase this time. They went down because companies during the ZERP unlimited QE period of COVID stacked up on cash, built up big mountains of it. Well, the rollover on that is about 5 years. That's now. And now all that rollover is going to start to happen at much, much higher rates. 300% higher, 400% higher in some instances. That's going to be painful. The global economy is slowing against that backdrop, even as the U.S. is booming, and the U.S. boom is not spilling over. All of this does not scream risk on to me. But at the same time, you can't fight momentum like this. So I'm not a buyer of U.S. stocks here, but I am definitely not a seller. I am
All right, I'm going to ask this
very
question.
happy with my short Europe, long dollars, short gold, long yields kind of exposure as and until. But I am looking at the S&P and the Dow and especially the NASDAQ with hungry intentions, wanting to short them aggressively the moment they tell me that there's a bit of blood in the water.
You're not going to be satisfied until you get a credit event. You're going to keep. You're going to
at some point.
Like
at
there's
some
never
point,
going to be a moment
pay.
where you go, you know what?
Debt is at some point due. At some point, you have to pay.
Okay, let me ask you this question. I want to antagonize you a bit. We're in the last 15 minutes, and that's why I like to do this. Explain to me, my friend, why we have a Federal Reserve. Everything you just said is projecting out inflationary fiscal policy. And why exactly do we have a Federal Reserve that's cutting rates right now and accelerating inflation?
We're going to see them change that.
Tell me why that's sound monetary policy.
Because they're going to change that. Because that was not the perspective from which they were approaching September. And indeed, if you looked at the way U.S. economic data has been behaving this year, everything the Fed has done has made sense. It's just they are as late as everybody else because they don't have any more of a time machine than anybody else. So what did the Fed do? We already were looking at U.S. economic data starting to deteriorate mid-April, May. But what did the Fed do? Oh, maybe we're not going to cut 3 times, maybe once. Inflation is sticky. Yep. They're always fighting the previous battle. But of course they are. They have to be. This is why they set their inflation objective in the medium term, which is 2 to 3 years-ish. Because on this kind of near-term calibration, they can't do anything. There's an outside lag, there's an inside lag. There's a lag between when you recognize your policy is wrong Then you change the policy, and then there's a lag of months, sometimes a year, before that change actually affects in the economy.
Mm-hmm.
The Fed is behind the curve, but of course they're behind the curve. They're people, not wizards.
Okay. So Stan Druckenmiller said in a recent interview a few weeks ago, he said one of the things he's most worried about is he believes sort of that post-COVID world, they stayed in easy monetary policy for too long. It was clear they were buying up mortgages, mortgage paper, stuff like that for a year after it was clear to him that they needed to pivot. In other words, he felt they got stuck into their own forward guidance. Yes. And what he said recently is he said, I'm nervous that they're not going to react quick enough to seeing the inflation and the inflationary picture that is coming to change their own forward guidance. He thinks they're already locked into this cutting cycle and that they're not going to be able to escape that forward guidance, or that they're going to be delayed in responding in the way that you've just put on the table. Does Ilya Spivak think that that's a risk of them getting locked into their own inflationary policy when they need to be reversing? Do you see that as a potential risk of 2025?
Of course it's a risk. I just don't think it's a big risk. I think they actually are much more mindful here. I think the episode coming out of COVID was a particular kind of flub, because I was one of the people yelling at them, you guys are missing that the inflation is getting sticky in the labor market. You keep talking about this transitory whatever, and you're not wrong. In the sense that, yes, supply chains will normalize. Yes, these things will fall away. Look at where goods inflation is now. It's negative. That's because they were right. It's just that was only half the story.
Less than half, right? Services is much.
Well, services is much bigger. The inflation rate has fallen by more than half off its peak. You could, and neither one of those measures is particularly meaningful. The point is, they missed the fact that you do not have the same issue you think you have if inflation has gone into the labor market, because when's the last time an employer has come to their staff and said, well, inflation is coming down, so your wages are hereby revised lower? That's not how that works. Mm-hmm. So things get locked in. They get sticky. I think they made a mistake there. They stayed for too long and got married to their own forward guidance. And I think the uniqueness of the pandemic sort of clouded their judgment in their own admission. They've owned it, to their credit. I think they have since become much more nimble. And you see that in them going 3 cuts. Okay, no, maybe 1. Okay, no, 4. It'll be really funny when it turns out to be 3 and they were right all along since back in December. That's going to be hilarious, by the way. You and I have talked about how the funniest thing for a Fed watcher this year is that it's the market that's been wrong the entire time, and the Fed was right all along since a year ago about where the right policy is. But they've been more nimble here. I think they're going to continue to be nimble. I don't think they want to screw this up.
All right, man. We get you on every Wednesday. One of the things I used to do, which people really liked, I haven't done it in a while, which was towards the end of the show, I said, okay, I'm not going to get to see you on this show for another week. Give me your 1, 2, or 3 top trades or positions that you have highest confidence interval in from now until the next time we speak. What are those 1, 2, or 3 trades and or positions that you have a high confidence level in?
I'm staying short gold. I'm going to want to put on a short euro position here very soon. I'm thinking maybe even today. I'm just looking at it and essentially saying, how much are you going to backfill of this ridiculous one-day fat finger before you decide that the longer-term dynamics are back? And the longer-term dynamics are down. So I'm looking and trying to figure out where the entry is on this. I wouldn't be surprised if we got back even to like 108. But I don't want to get too cute by half. So I'm looking at where the entry is on here, but I expect it'll be coming soon. And I'm also looking at essentially any regional stock market that's immediately in the line of fire of America first. Because
what are those in your mind? Just a handful.
So the one I already have on is Europe, FEZ. I did it through FEZ rather than EZU because I wanted specifically Eurozone stocks, and the vol here was a little bit cheaper than it was in EZU, which is the MSCI Eurozone benchmarked index. This is specifically Euro Stocks 50, the index itself as the benchmark. So I like this. I might add into it since it took out its low. I'm also looking at Mexico, EWW, because I think one of the more interesting parts of this.
Look at that rip today.
Crazy rip, which is, again, sort of incongruous because one of the biggest threats policy-wise in the way that a Trump administration would deal with immigration would be very onerous for Mexico. If we, for example, went to a stay in Mexico kind of policy, things like this. So if they try to continue to push Mexico to become what's called a safe third country, where essentially somebody that wants to seek asylum in the U.S. has to first seek asylum in Mexico and then wait in Mexico to try to seek asylum in the U.S. That Mexico basically has to take people that end up there along the way. That will be very economically onerous, and Mexico doesn't want to do it. So we'll see what that means here. I think today's reaction was obviously very interesting. Massive gap higher or lower than a rally higher to close that gap, so that from day to day you don't actually end up with very much of a change. I'm looking at this and seeing maybe there's something to fade here. Maybe what we've actually done is broken low, and we have room to keep going down. I'm looking at the Aussie dollar, which held at support, and see if maybe that cracks, because I want that as my window into being short China. It held that support today. RBA was resistant to cutting rates earlier in the week, but their inflation numbers missed last week. Their bond market is going to be annoyed, and it's going to say, oh, so you're not even going to cut with the Fed looking more hawkish and the pressure from global yields mounting and inflation missing? Get your house in order. So I'm looking for that as a sell as well.
All right, last thing. Ilya, you and I have had tons of conversations offline. Yes. Some things we agree on, some things we don't agree on. I'm curious, like in a post-election world, I'm hitting you with this like totally. I didn't prepare you for this question, but like, what would your message be to the American people? Or what do you take away from a tightly contested campaign and now moving on and away from the campaign and just now forwarding on what we need to do to move forward? How do you think about, how does Ilya Spivak go, okay, that was the result. I was either for it or I was against it, but now I'm transitioning. This is my focus now for the next 4 years.
Be as the markets. Be as the markets. Take the certainty of the outcome that you now have. Make the adjustments that you need to make in the way that you conduct your business, given the certainty that you now have, and move forward. There's another election cycle in 2 years. If you didn't like this outcome, vote again. There's another presidential election in 4 years, fingers crossed. If you didn't like this outcome, vote again.
Well said. If the people want more from you, and they should, tell them where they can go.
As ever, I'm all over the Tasty Live network. This show, Macro Money, Overtime, Futures Power Hour now twice a week, up from once on Mondays and on Fridays with Chris. Overtime 4 days a week. You and I talk to Tom for First Call at the Asia Market Open on Sundays. So everywhere, all at once. Writing for the news and insights portion of tastylive.com. Jabbering away on the probably now more convincingly former Twitter machine at Ilya Spivak, though I still refuse to call it X. And otherwise, just everywhere where there is an opportunity to talk macro, all over the place.
My good friend Ilya, it is, I say this every week, but it is true every week. It's always a pleasure to get to chop it up with you, my friend, and get to dance around or
Likewise.
Listen to what's going on in that mind of yours. If you want to follow me, everyone out there, for whatever crazy reason, you can on X or Twitter at Victor Jones. The Owen Jones is 0 because I like to be difficult. I'll see you back here tomorrow. Same time, same place, same great network. For Ilya Spivak, I've been Victor Jones. Peace.
Wonders. Do you remember we went through in market measures what the calculation was for expected moves in stocks, and you take the volatility and you divide it by remember the number?
19.
Correct. Divide by 19. So Trump Media does have options. And the November 15th expiry is trading on a volatility of 414. I've never seen anything like it.